Okay, welcome everybody to the first ever Gilman Hill quarterly client conference call. We are so happy that you're joining us, grateful to have you all here, and excited to get started. First, a quick firm update. We are still at about 50% capacity of our employees in at Gilman Hill at any one point in time. So some people are working from home, some people are rotating. I should have started with saying, I hope that you and your families are all healthy and that everybody's holding up. We are all healthy here. We actually did get tested about 2 weeks ago, and we all came back negative on both our antibody and virus tests. As Andrew would say, our colleague Andrew would say, we were all very negative. So that was a big relief. Our protocols here are that we are wearing masks in the common space, but when we're in our own offices, we are not masked, and we're doing Monday morning team meetings via Zoom. So we're starting to get pretty good at this. It's not my preference to have half of us working from home and rotating, but it's working really well, and it's going better than I ever would have expected it would. So that's our quick firm update. As I mentioned in one of the client notes that I sent out recently, the theme that I keep coming across over and over is acceleration. And so many things have accelerated. I did my first Zoom client conference call actually down from I was in Easton, Maryland, and did a call with an international client last November from the Tidewater Hotel. And I did not expect at that time, when I did my first Zoom call with a client, I did not expect to do another Zoom call with a client for at least 6 months. Little did I know that soon I would be doing many, many Zoom calls a day. So prior to all of this, I had never had a meeting with more than a client at a time. You all know how much I cherish our individual relationships, intimate conversations, and being able to really know all of you. So I never thought that I would think it was a good idea to do a group client call, but here we are. The crisis has quickly gotten me and Greg and John comfortable with using Zoom and seeing that it's actually useful and not terribly uncomfortably impersonal, and it's a good way to communicate. So that gave us the idea of starting to do these client conference calls following the completion of our quarterly letters. As you all know, so much work goes into these letters, and there are always many more things that we would like to share and express. There's so much that goes on behind the scenes of them. So we thought, hey, now that we're comfortable with Zoom, now that we're getting good at this, now that our clients seem to be comfortable with it, let's do a quarterly call and recap what we've talked about in our letter, and also expand on some of the things that we don't have room to expand on in the letter. So our goal for this call is to talk for about 30 minutes and then open it up for questions. With respect to questions, please go ahead and use the chat function on Zoom or email in. John is monitoring my emails, and he will be the captain of the question asking. So you can just email me, and he will ask the questions when it's over. Please don't be shy. As you all know, I love a good conversation and I love questions. So fire away. If we don't get to your question for any reason, I will follow up with you personally afterwards. So we're going to start, we're going to try to follow basically the way the letter goes. And we're going to start with a recap of the second quarter. As you all know, Greg and I talk a lot. Like, we talk all day, all the time. Last year, our colleague Andrew, who's on the phone too, who's our associate portfolio manager, sent Greg and I, maybe the whole firm actually, an email with a link in it to a TED Talk. And the subject I think he had was something like, these are 18 minutes of your life that you won't want back. And it was to a TED Talk by a guy named Steven Pinker, who is a psychology professor at Harvard University. And what the TED Talk was based on is he asked the question, is the world getting better or worse? Let's look at the numbers, rather than just letting our emotions tell us if the world's getting better or worse. So that's something that we've thought about. We've read his book. We've really enjoyed his data-driven approach to answering questions, particularly in times of emotion. So as Greg and I were sitting here starting to get ready for writing this quarterly letter, and we were thinking about everything that had happened over the past 3 months, Greg said, well, it's like Steven Pinker says, destruction makes headlines because it's fast and dramatic, but progress does not because it's slow and incremental. And I thought, aha, that's the way that we should frame the section about what actually happened in the second quarter by using the title of his TED Talk. Is the world getting better or worse? Let's look at the numbers. Because I think to all of us, with all the emotions that we've experienced over the past 4 months, certainly feels like the world's getting worse. I don't think it actually is. So what we're going to do is first we're going to look at what happened with the virus, and then we'll look at what happened with the economy. over the past 3 months. And we are going to contain our comments mostly to the past 3 months up until we look forward. So Greg's going to share with us the data on what actually happened over the last quarter. Okay, Greg, take it away.
All right. So we, as when we started to look at the letter, some of the headlines we're getting on the virus are, in some cases pretty scary. The cases are rising right now, but when we looked at the quarter, there was a remarkable amount of progress that was made over the course of the quarter. I think we forget what things were like 3 months ago. So when the second quarter started, we were 2 weeks into the shutdown. We weren't sure if the shutdown would actually work and contain the virus. We didn't even know how the virus spread. Cases were spiking at the time. The Jacob Javits Center, the convention center in New York City, was being converted to a hospital, to a makeshift hospital. The USS Comfort ship was coming up to help out New York City in treating patients. We had a shortage of respirators, and there were no treatments for the virus. Now you flash forward 3 months later, that we've made a lot of progress, steady incremental progress in terms of the virus over the last 3 months. So in testing, at the beginning of the quarter, we were testing about 100,000 people per day. At the end of the quarter, that was up fivefold to 570,000 tests per day. Now, even just 2 weeks after the end of the quarter, we're up to 730,000 tests per day. So a huge increase there. Deaths, the peak rate of deaths was about 2,000 per day in April. That fell to a low at the end of the quarter of 600 per day. It's about, even though it has risen in recent weeks, it's still only 730 per day. The number of cases, I think it's been well documented by the media that we went from 25,000 cases per day at the beginning of the quarter down to a low of 20,000 cases. So it was a big reduction, and it had peaked in the 30,000 plus cases per day. Of course, that has rebounded recently, partly due to more testing, but a lot due to the viruses spreading more recently. But so there's about 65,000 cases per day. Outside, what doesn't get a lot of coverage in the U.S. is the progress we've made in controlling the virus outside the United States. So I look at international a lot, through our investments. But in the European Union, which is roughly the size of the U.S. in terms of population, they're getting about 4,000 cases per day of the virus compared to 60,000 plus in the U.S. today. So they've done a much better job of bringing the virus under control. And Asia has also brought the virus under control in most countries. China has a very limited number of cases. Japan has had some spikes in the virus, but they've been looking to keep the virus under 100 cases per day for the whole country. So they've got a lot less tolerance for outbreaks. And there have been some outbreaks in Brazil, Russia, and India, but overall on the globe, most countries have successfully controlled the virus, which was it's a much different place we were at the beginning of the quarter. As far as treatments for the virus, at the start of the quarter, there were no treatments. At the end of the quarter, we now have remdesivir from Gilead is approved to treat the virus and show some effectiveness. Doctors have learned to prescribe anticoagulants. That helps a lot. A low-cost steroid, dexamethasone, has been found to be very effective at treating the virus. The use of convalescent plasma has been very effective. So we've come a long way. We haven't found the miracle cure, but we've come a long way in terms of treating the virus, and that's probably the reason behind the deaths per day coming down from 2,000 per day to down to 600 per day. And then on the vaccines, there's been a lot of news in the last week on vaccines, but we went from no vaccine to 13 vaccines in human trials at the end of the quarter. And now we got some promising phase 1 results. Moderna, AstraZeneca, and Pfizer are going to start phase 3 studies shortly. And mass production is getting set to begin shortly. So there's been a tremendous amount of progress on vaccines, because the conventional wisdom on vaccines was that it would be 12 to 18 months at the earliest, and it could have been a lot longer to the vaccine, but that timeline seems to have been accelerated in the last 3 months.
Right. In fact, we were just on a conference call with Dr. Scott Gottlieb from he used to head up the FDA, and he's been a really wonderful resource for us. And one of the things he was talking about is that it is likely that by next winter, I think I would argue very likely, he said aggressive, but also very likely that vaccines will be in mass production and you and I can go get them if and when we want to. So that was a little reassuring, despite all the other unreassuring news that's out there with the cases increasing. Okay, so with respect to the US economy, we've seen improvement that's been driven by gradual reopening, stimulus, and pent-up demand. We've seen things over the past quarter like retail sales had an unprecedented drop in April. They dropped between March and April by 14.7%. That's almost, I don't think that's ever been seen, such a dramatic drop before. Then they grew off of those April lows by 18% in May. So we had down 14%, up 18%, and then June numbers just came in this morning and retail sales came in at up 7.5% in June. Automobile sales, going into this crisis, they were expected to be about 18 million sales a year. They plunged to 8 million in April. Those are back up in June to about 12.5 million. That's improving. Oil, which started the quarter at $20 a barrel, got crazy in the middle of the quarter, ended the quarter in the $40 a barrel range. That's a really healthy level that shows that supply and demand are in balance in a functional, profitable way for the oil companies. Unemployment going into this crisis was amongst the lowest it's ever been in the past, 30, 40 years. It was at about 3.5%. The unemployment rate peaked in April at 14.7%, and it's been on a decline since. It just came in, numbers just came in for June a week or two ago at 11.1%. So still terrible, but improving. With economic data, what matters is the trend, particularly in an environment like this. Absolute numbers are fairly meaningless. It's the trend that's important, and the trend that we're looking at. We think that even with cases increasing, even with things not going as well as any of us had hoped they would, we think that to some large degree, reopening remains. Even if it slows down from the trend that reopening was on, it remains. And the trend of this economic data stabilizing, getting better, not returning to March or April lows will continue, and that's good. So we've also seen that that's largely true outside of the US as well. And Greg will go into that.
There's been a big improvement in Europe. The virus peaked a little bit earlier in Europe than in the US. It peaked in early March. So April was, the economic data in April was terrible, but May has seen a sharp rebound. So in just some examples, Germany, retail sales were up 14% in May. They were actually up year on year. So this May was better than 2019 levels. That's how fast consumer demand has come back. France, same situation. Consumer spending was up 37% in May as they reopened their economy. It's not just Europe, it's Asia as well. China has been leading the recovery. Their virus, the virus peaked in China in early February. So they've been several months ahead of most countries. But retail sales in May were down only 2.8% from the previous year. And industrial production in China is actually up year on year. And China reported today that their GDP was up 3% in the second quarter. So they're the first country to post positive GDP growth following the virus. And we would expect a similar path in other countries as they bring the virus under control and reopen the economy. That we'll see a pretty fast return to growth in most countries.
Right. Okay, so now I want to touch on the performance of the portfolios. All three strategies, the dividend income strategy, the international income strategy, and the disciplined growth strategy, all had very good second quarters, but are all, as you all know painfully well, are still way behind the S&P for the year. However, we are continuing to see improvement so far in July, and we do expect that to continue both on an absolute and relative basis. This is an aside, but I had an interesting conversation over the weekend. One of my former colleagues from when I was at Goldman Sachs is still at Goldman Sachs. He's in the private wealth management area. And that's the area there that covers the clients, that manages wealth for clients of $25 million and above. It was really interesting because he called and he was just kind of like lamenting life and lamenting the fact that it's quarter end and that he needs to report to his clients and how hard it is. And what he said, and I think this was well phrased in his monologue lament to me, was that unless his client's investment policy statement or their own decision for their portfolio, unless those said it is okay to have 20% of my total net worth in 5 companies. Their returns are way, way, way behind the S&P 500. I'll get to that in just a second because I know I touched on it in the letter and I've been talking about it as much as anyone will listen to me about the top 5 companies taking up a disproportionate weight and really leading the S&P 500. We've talked a lot about how the S&P 500 is not representative in terms of return, particularly of what the broader market's doing. But it was just interesting to hear my friend at Goldman with these huge $25 million clients say that they were way behind the market as dictated by the S&P 500 because of not having 20% in 5 companies. He said any client of his with any level of conservativeness or diversification was way behind. He also said that, and we experienced this exactly at Gilman Hill, and it was interesting to hear that they experienced it too, that the divergence was so significant over the past 2 quarters. Really, most of it came during that first quarter though, that looking at Goldman's clients' returns to their 1, 3, 5, and 10-year benchmarks, suddenly where they'd been right in line with the benchmark, suddenly that diverged too, because most benchmarks do use the S&P 500. So for me, I'm just sharing it with you because I thought it was interesting, but it was also very reassuring and along the lines of misery loves company for me. With respect to the top 5 companies and the performance of the S&P 500, one of the things that we've been talking about is that there are 5 companies right now, Apple, Amazon, Microsoft, Google, and Facebook, that make up 20% of the S&P 500. The last time that happened was at the peak of the market just before the dot-com collapse. The 5 companies then proceeded to underperform the S&P 500 for the next decade by about 36%. I'm actually going to need to rein myself in right now because if I start talking about this, the whole hour is going to be gone. And I am working on writing a paper on this as soon as I'm done with quarterly reporting, which is almost done. I am going to be working on writing a paper on this. And if I do, and if you all enjoy it and want to talk more, we'll do a conference call just on this topic because I think it's really interesting. But we've seen a lot of divergence, and this is noted in the quarterly letter too. But if you take out those 5, the return of the S&P 500 for the quarter would have been down 11%. If you look at just the growth stocks in the S&P 500, those were up actually 15.5% on the year, while the value stocks were down 18% on the year. The gap between that is unprecedented. And I do expect in the coming quarters that those gaps will close. And as those gaps close between the haves and the have-nots, between the value and the growth, however you want to phrase it, as that gap closes, we will be the relative beneficiary. So I'm feeling actually quite good about what we're invested in and how we're invested for the future. Okay, I'm going to put myself on hold on that before I get too wild and crazy and get into too many details. And I'd like to move on to the portfolios specifically, and then on to our outlook for the rest of the year. So with respect to the equity income portfolio, I'm going to be super brief about this because I've already inundated you all with notes on each of the 5 companies that we bought, and then repeated that in the quarterly letter. If anyone wants more information on this, I'm happy to do one-off calls. But with the equity income portfolio right now, our forward multiple is 11 times. The S&P 500's forward multiple, just so you have a point of reference, is 22 times. So big divergence there. Our dividend yield is about 6.8% right now, and we have a portfolio of a little over 30 stocks invested in great companies. During the quarter, we added 5 new investments. We added National Retail Properties, a Nextera preferred stock, Unum, which is an insurance company, Viacom CBS, which probably everybody knows, and Seagate, which manufactures hard disk drive and flash storage for when you back up your phones. We expect to add probably 2 to 3 companies between now and year end, but the majority of the transitioning and repositioning of the portfolio following all the destruction from March, April, May, that's mostly done. Not completely done, but mostly done. I think the biggest risk to our portfolio right now is not if the market implodes and things are awful in the market. We are really in a good, safe area. I think the biggest risk is rather if those top 5 companies continue to explode to the upside. I think it's underperformance underperformance to the broader market that's our bigger risk, rather than us declining more in a major market decline. We'll get into outlook. No, I do not expect a major market decline. Okay, Greg, you want to go into the growth portfolios in the international?
Sure. First on the growth portfolio, we did add Intel during the quarter. This follows the purchase of Thermo Fisher and the at the end of the first quarter. So we've added 2 companies that have been less disrupted by the virus. They're actually doing quite well. Intel has seen some of their businesses benefit and should deliver a solid first half of earnings. And it's trading at only 12 times earnings. So it's, I think, a really cheap tech company that can grow. To fund these, we've sold out of Mohawk, which we had concerns about the carpet and tile floor market. We've also trimmed Home Depot and Facebook. We still like both companies, but the valuation's got a little bit higher, and the position sizes were quite large in the portfolio, so we trimmed those back. We haven't added a lot of new names in the growth portfolio. We feel that a lot of the best opportunities are in the market or in the portfolio already. We've had a lot of the portfolio is in because they're growth companies. They've got a lot of economic sensitivity, and these companies have been we feel have been oversold. So there's I think a lot of good opportunities for a potential rebound. The portfolio only trades at 22 times earnings, which is in line with the market. We feel we've got above average growth prospects in the portfolio, and a lot of the companies, the earnings are at depressed levels, and we feel pretty confident about most of them that there should be a quick rebound in earnings in 2021. As far as the international portfolio is yielding still 4.8%, trades at only 13 times earnings, which is a discount to the international market and an even bigger discount to the U.S. market. So we think it's attractively valued. Last quarter, we did sell out of Las Vegas Sands, which had cut their dividend, and we had some concerns about growing debt on the balance sheet. We added to some names in the portfolio, including Sumitomo Mitsui, which is a Japanese bank trading at near half times its book value. A very cheap Japanese bank with a 6% dividend yield, and Total, the French oil company, which has got a yield of 7%. So we added to those positions. We did have a couple of companies that suspended their dividends during the quarter, and that just delayed issuing the dividends. And there was a variety of issues during the quarter where many companies delayed their board meetings out, as far out as normally would have been held in April, were actually taking place in August. So some dividends got delayed from the second quarter into the third quarter, and also a few companies are delaying their final decision on their dividends of this year. So, but we've decided to hold, besides Las Vegas Sands, decided to hold all of them, which has been good. Most of them the shares have rebounded sharply. We're going to get greater clarity on that this quarter on what's going to happen with the dividends, and we may make some adjustments if we feel the dividend is not coming back quickly. We will go ahead and sell that and buy. There's plenty of opportunities to find companies that are yielding 5% or higher in the market, so we can replace the income very quickly.
Okay, so let's go into the market outlook, and I'm going to give you our outlook for our portfolios and for the market for the rest of the year. So I'm going to give you the punchline first. The punchline is that we expect it to be very choppy, but upward trending. And the reason why is because things are getting better, right? They are not deteriorating. Even with the cases spiking, the economy is getting better. Life for most of us is getting better. But the choppy part is because there are 2 particularly large unknowns ahead of us in the next 6 months: the virus and the election. Both of these we think will see resolution, or at least extreme clarity, by year end. But as we get closer to resolutions with the virus and the election, we think that the market's probably going to trade around and be pretty wild between now and then. So Greg, you want to go into the election part of this?
Can I cover the virus?
I meant that, sorry.
Yeah, I'll leave the politics to you.
Okay,
as far as the virus, we should get a lot of clarity over the next few months in terms of potential treatments and vaccines. On the treatment front, there are hundreds of treatments that are being studied right now in many of them in advanced phase 3 trials. And we're going to be getting results on them very soon. The most promising of which are the antibody drugs being developed by Regeneron, Eli Lilly, and a couple of other smaller pharmaceutical companies. They went into trials a few weeks ago, so we should start to be getting some data to see if they're effective. And many people believe that the antibody drugs will be are the best chance we have at finding a cure for the virus. So that's pretty exciting. And then on the vaccine front, we've had promising phase 1 results. We've got large phase 3 studies starting on 3 of the vaccines, and some more will follow. Mass production starting already. If you like Dr. Fauci, with the government, he believes there'll be an approved vaccine by year end. The timing's still uncertain, but the most likely outcome is that we are going to have a safe and effective vaccine by early 2021. And we'll know more by this fall, as we start to get the results from the trials. Now, there are a lot of worries about the second wave of the virus before year end, and that mixing with an outbreak of the flu. But first, we think it's a little early to be worried about the second wave when we're still fighting the first wave of the virus. But and there's still a lot of unknowns about the virus. But we are heading into the fall with an increase in the wearing of masks, still practicing social distancing, hand washing, separating people. So we should be able to, if those measures are practiced, be able to control a second wave of the virus. And also those actions should also prevent a widespread of the a spread of the flu as well. And as we've always said, the cure with the financial crisis, the cure for the financial crisis was having a financial crisis. We spent the next 10 years prepping for the next financial crisis. The same thing's going to happen with viruses and infectious diseases. We're going through this process is going to make us more prepared and prevent the next outbreak from happening. Just through the awareness and the measures we're taking today, and understanding how viruses spread, will be better prepared to control the spread of a virus.
Right. So, as those of you who have kids know, or grandkids, children are filthy. Greg's much more polite than I am. Children are filthy little flu spreaders. And I think it's interesting as we're seeing the schools get ready to go back, because they're all keeping the kids super distant. They're going to wash their hands. I'd be surprised if there's not kind of a silver lining to the preparation or keeping social distancing. I wonder if the silver lining is that the flu season this year is actually really, really tamped down, because the little ones in the school aren't going to be just touching each other and passing all the germs. Anyway, on the election, this is another major unknown for this year. This is probably, just as an aside, I would say over the last 3 weeks, almost all the questions and conversations that I've had with you all, this has been the focus of the topic of focus, which I think is interesting. It seems to me, and I don't know if this is true outside of my client group and my conversations, but it seems to me like the focus has really shifted almost a little away from the virus and into the election. And I don't think it's that we're not paying attention to the virus. We all obviously all are, but it is what it is. And we all know how we're getting through it. And now there's something new to start worrying about, and that's the election. So the way we're thinking about this from an investment perspective is ahead of an election, ahead of a presidential election, 100% of people are a little worried. They're worried that their candidate is not going to be the one that wins, that they're not going to have the right outcome. So 100% of people are climbing this wall of worry up until the election. After, the minute that thing's done, 50% are cheering and 50% are crying. But once it's done, it's done. And you know what you've got, you know who you've got, you can start to look at, what's handed to you and move forward from a personal perspective, from a business perspective. I've definitely been getting questions kind of along the conspiracy theory line. That might be a little extreme, but what if it's so heavily contested that we don't know, that it drags on for a long time? With respect to investment decision making, I'm not factoring that in to something that I think is legitimate to worry about at this point. I think that we're going to know the outcome. I am at this point looking at electionbettingodds.com. I don't know if any of you know this, but it's a website and it's literally electionbettingodds.com if you want to go to it. And what it does is it looks at where people are actually putting their money. So it's not just the Quinnipiac poll, or the Washington Post poll or the Wall Street Journal poll that all have biases and hoping that people pick up the phone. But this is actually where money is being put. At this point, Biden has a 20-point lead over Trump. So from an investment perspective, and as I'm thinking forward, as we're thinking forward as a firm, we're expecting a Biden win at this point. I know there's 4 months to go, and that's a long time. Last week, we did a conference call with a political think tank down in DC. It's completely bipartisan. And they said that despite the polls, don't count Trump out yet. So that's just out there too. All the same, we think probably likely that Biden wins, probably likely that the House stays Democrat. As far as the Senate goes, who knows, but we'll find out soon. I think there's a difference between conventional wisdom and fact. And a lot of conventional wisdom, or people will say, oh, if it's a Dem sweep, right? So if it's House, Senate, presidency, all Dem, that should be really bad for business. That should be really bad for the markets. Conventional wisdom will also say that a fractured government is better because nothing happens and stagnation is good and there's more clarity. I'd like to share a slide with you real quick that shows otherwise. So hang on for 1 second. And for those of you on the phone, I'm happy to share this later. This is from Gary, who's dialed in right now. This shows you that when the White House and Congress are Republican controlled, the markets historically have returned a little over 15%. When it's a Dem sweep, right? When it's House, Senate, White House, all Democratic, they've returned a little under 15%. And I think that this is really interesting, especially if we go back to the Steven Pinker, let's not use our emotions, let's look at the data. The reality is from 1945 to 2019, when one party controls White House and Congress, the market is just fine. I've got one more slide. Shoot, hold on, how did I get to it? One more slide to show you. Hold on. Hold on. I think I've screwed this up. Okay, hold on. Share my screen. Okay, here's another one. This is what happens when a Democratic sweep actually comes in. And the reality is that the market, on average, under almost any of the last full Democratic sweeps, has done quite well. On average, it's been up, like I said, just shy of 15%. On average, median is up 15.6%. So I think that as many conversations as I've had about this, it's not something that I think we should disproportionately worry about. I think that we need to remember that politics are politics, and American business marches on, and American people are resilient, and we will move on in the face of whatever congressional structure and presidential structure we have. So with that, let's get into bigger things that should influence the market. Craig, you want to take it over?
Yeah, just tying everything together. Knowing that the political risks and the risks around the virus we're going to have greater clarity on that over the next few months or second half of the year. We could start to turn our attention to the traditional drivers of the market. Things like the economy, the earnings, the Fed policy, valuations. And I think we need to, even though some of the headlines are a little scary on the virus, we need to remember that the market is always looking 6 to 9 months out. So the market is focused on, what's the economy and earnings are going to look like in the first and second quarter of next year. I think we'll start to get clarity on what that is. But we think that earnings are going to have a strong rebound in 2021. The consensus estimates right now are calling for a 29% rebound in 2021 earnings compared to this year. We know that the Fed is most likely going to keep rates low. Jerome Powell, the chairman of the Fed, he said last month or 2 months ago, he said that we're not even thinking about raising rates. So I think we've got pretty good visibility that the next year, or probably 2 years, we're going to have rates, central bank rates near zero. And the market's trading at 20 times earnings, which is higher than normal. But you've got to remember that first there are 5 or 6 large mega cap companies that are driving up the valuation that are a lot more expensive than the rest of the market. And also earnings are at depressed levels. So I don't think 20 times earnings is that high, especially considering the alternative is treasuries trading with the interest rates below 1%. So we think that the market is still fairly attractive It's certainly going to be a bumpy road, but we're still cautiously optimistic about stocks. Now, on looking at what's likely to do well and what's going to do poorly, we believe that international stocks are well positioned in this environment. I think what's gone unrecognized by the market and the media is that the virus is under control in most parts of the world. That hasn't the international has underperformed in the first 2 quarters of the year, despite having much better virus numbers. In addition, valuations for international stocks are a lot cheaper than the U.S. The average international companies trading at 17 times earnings versus 22 times in the U.S. Our international portfolio, we're able to buy portfolio stocks trading at 13.5 times. So there's a lot of really cheap international companies out there. And I think one of the interesting things will be the coming wave of fiscal and monetary policies internationally. The U.S. has dominated the policies, and the Fed and the federal government acted really quickly early on in the virus with massive programs. A $3 trillion expansion of the Fed's balance sheet, $3 trillion of fiscal spending. So what was going on overseas was kind of overshadowed, but that should change in the second half. There's already talks of a big spending package out of the Eurozone. Bank of Japan has announced some ambitious plans. Individual countries in Europe are going to be announcing some pretty big fiscal spending packages in the coming months. So I think there's a lot of potential for policy internationally. So I think international stocks are well positioned. In addition to them, in the growth portfolio, we think the outlook for the U.S. consumer is pretty strong. There's still a lot of pent-up demand. The savings rate recently, just because people cannot spend their money, they're not allowed to go to certain stores or go on vacations. The savings rate's been really high, so there should be a lot of pent-up demand. Interest rates are low, mortgage rates are low, energy prices are down, so the people are spending less money on energy and have more discretionary income to spend. And that should lead to a strong rebound in consumer spending in the second half of the year and carrying into 2021. So we're optimistic about the U.S. consumer. Another area of growth I see is in the tech sector. Although the tech sector has performed really well, outside the largest companies, there's still a lot of value in tech. And in the growth portfolio, we have I think Intel, Cisco, Applied Materials, Teradyne, Fiserv. These are companies that are still growing, trade at we believe reasonable valuations. So I think there's a lot of opportunity in the tech sector. That the digitalization that we've seen in the past 6 months, that's a trend that's not going away, and I think there should be a pretty good growth driver for the sector. But you've got to be careful in that you buy companies at reasonable prices.
Yeah. Okay. So I'm going to jump in for 1 second. So what we think may not necessarily do well would be bonds, and then the particularly frothy high valuation stocks. Just summarize, finishing up our outlook, and I know we're a little over schedule right now, sorry. But what we're looking at as we get even farther out from this year, as we start to worry about what we'll worry about in 2021, we're thinking about where the areas of permanent damage will be to the economy. What were the unanticipated consequences of the shutdown that we don't even know yet and won't find out until next year? We're thinking about the $3 trillion of debt, and will it stymie growth? Will governments encourage inflation to decrease that debt burden? We're thinking about the regulatory environment, and will the traditional the traditional sectors like banks and healthcare be under attack, or will it be the mega tech companies, and what will that look like? So that's what we're starting to think about as we think even more forward. Now that I've dragged you into our world of worry, we'd like to open it up to questions, but I want to say one thing. Please don't be overly worried. We worry all the time. I frankly worry even more when the market's good and frothy and exciting, because I'm always looking over my shoulder then. At this point, I'm able to look up, not over my shoulder as much. And I do think that there's plenty of opportunity and plenty of money to be made in the future. I frequently joke with some of you that that amongst the other things your fees cover are me getting the gray hairs for you. So, please, don't worry about us. We'll worry for you. Above all else, we view the U.S. and the global economy as an ever-expanding pie. And we see the world not just now, but always getting better, not worse. And I do encourage you to watch that Steven Pinker TED Talk on the subject of the world getting better. It's quite reassuring. There are always going to be bumps along the way. There always have been. There always will be. But the world is growing and improving. And with that, let's take your questions. So I'm going to check the chat function. And then, John, if you don't mind taking yourself off mute, if we have any email questions, it would be great.
Yep, got a couple of questions so far. One double question, could you talk a little bit about CDOs? And then the second part, not necessarily related, is what do you think about the overabundance of day traders, millennials buying penny stocks, and what's that mean for the market?
Okay. Greg, do you want to take that or do you want me to?
Let me hear your thoughts on that.
Okay. So for so CDOs are collateralized debt obligations, and that's what dragged us into the depths of the crisis. And that this might be an overstatement, but they played a huge role in the 2008-2009 crisis. So I think earlier in the call we mentioned one of the cures for the next financial crisis was that we've spent 10 years preparing for a financial crisis. I'm not too worried right now, but there's definitely rumblings that maybe I don't know if I should be more worried than I am. We're paying attention to the CDOs. Greg, do you have a differing opinion on that? Like, do you see them
I
as,
think just they're obviously, you can't have the levels of economic contraction we've had without some credit issues popping up somewhere. But I think the encouraging thing has been the earnings from the banks this week, where you see how well capitalized the banking sector is and how much they're able to take large provisions on their loan portfolios, and yet still most of them had positive earnings. I think it's just that there's such a difference in the last 12 years in the health of the banking sector and how the financial sector is there to, I think, help out the U.S. economy this time, where 12 years ago that was not the case. We were bailing out the banks, and that's going to make a difference in the CDO market. I think is that they've been. I think it's not all true, but I think most players in the market have been better behaved than they were 10 years ago.
I think that's true. Yeah. And then on the small players, we were actually just talking to one of our international clients this morning about this. I don't know if you're all familiar with this Robinhood. It's been in the news a lot, but Robinhood is a trading platform for, as I know it, people who have like $1,000 or $5,000 and suddenly they can trade. And there's been a lot of noise and a lot of headlines in that. And I think at the margin, these smaller players have come in. It reminded me, I don't know if you all remember this, but there was it was like a Scottrade or E-Trade commercial back in the late 90s, and it was a guy driving a truck, and he had a picture of an island swinging, and he picks up, it's a tow truck driver, and he picks up a guy, and the guy goes, "Oh, was that your vacation spot?" And he says, "No, it's my island, I own it," and then they flash to E-Trade. To me, I'm definitely having flashbacks of that, where at the margin there are these little pockets, or this pocket of small investors that are driving some of the craziness that we're seeing in smaller names, maybe in Tesla, in things like, what was it, Hertz, that actually filed bankruptcy and then started trading up because all these tiny traders started coming in. I don't think for us, how we invest for your portfolios, I don't think it's significant. I think it's just noise at the edges that's maybe annoying and maybe will cause some market fluctuations. But for the long term, I don't think it's disruptive. What do you think, Greg? Anything different?
I think I agree with that.
Okay. Okay, I just got a chat message. It says, for tax planning purposes, would you expect this year's net realized losses to be much the same at the end of the year as they are year to date? What a practical question that I'm sure you all want the answer to. The answer is yes, I would. So if you are talking to your accountants right now, I think that most of the trading and repositioning has been done. You are probably safe to tell your accountant, everyone's got losses this year. I'm sorry, I wish it weren't the case. But you can say, these are my losses and this is what you can work with. That should not change dramatically. If anything, it might tick up a little bit as a few final trades or a few final stocks are kicked out. But that's definitely a safe number to use for tax planning. Thank you for that question. Okay. John, do you have more from the interwebs?
Yeah, a couple more. Question about valuations of the broad market. The S&P at 22 times, is that too expensive? Are you concerned about valuations?
Greg, why don't you take that one?
No, I think it's a question on the S&P 500's 22 times earnings, but then when you quickly look elsewhere, there's a lot of companies that are not, they're a lot cheaper than 22 times earnings. And, relative to the market still has a dividend yield somewhere just under 2%, compared to bond yields of 0.7% is still, I think, pretty attractive. There's plenty of arguments why the valuation should be a little bit higher than normal, given that earnings are depressed, beginning part of the economic cycle, and interest rates being so low and expected to be low for a while. I think we can have a higher multiple, and that multiple should shrink as earnings rebound fairly quickly next year and into 2022. So I'm not too concerned, and plus I spend most of my day looking at international companies which trade at a 20 to 30% discount to their U.S. peers. So
yeah,
I have a different position.
For me, it's not the number 22 times or 21 times that's concerning. It's what I touched on earlier, which is there's a huge gap, and there are companies out there that are trading at really gassy, fumey, sky-high valuations, and then there's tons that are trading really, really low. So I don't mind the 21 times. I just have I have concern about how disproportionately weighted it is on both ends. I would not be surprised if the companies that are trading at 30, 40, 50, 60, 100 times, I wouldn't be surprised if they either plateau or decline a little, and the companies that are trading at 5, 6, 7, 8, 9, 10, 11 times, if they start to come up, the market could still maintain that same multiple, but the breadth or the width of who's on each side narrows. That would make for a healthier market. And I think that's probably where we're headed. Okay. John, do you have any more? No more.
Yeah, I have a question for Greg on Japan, about his view for it. The weighting in the international portfolio has gone from 0 several years ago to about 16%. Just what are his thoughts on that as a market?
Oh, good question. So my background is I started as a Japan analyst many years ago, and I've always covered Japan, and I spent 4 years working for a Japanese brokerage firm, covering, looking at Japan very closely there as well. So when I started at Gilman Hill 7 years ago, it was kind of shocking, I think, to Jenny, that we had no Japanese holdings, that we couldn't find anything with a decent dividend yield. But Japan's been undergoing a dramatic change in the last 10 years, where companies are increasing their payouts to shareholders. Japan's got a reputation for being shareholder unfriendly, hoarding cash, and that's changed a lot. And so we've got a lot more companies to choose from, and there are a lot of companies in the market now yielding 5% and higher. And remember, that's against the backdrop of Japanese government bonds yielding 0% or lower, a lot of negative interest rates. So it's very easy to find companies with 4, 5, 6% yields relative to no interest rates in the market. So I think it's quite attractive, and Japan is truly changing. It's getting better. I think it's one of the better opportunities in global markets right now, that you get high yields, and there's some, and don't confuse low economic growth with earnings growth. Earnings growth is actually, it should be pretty strong out of Japan, even though GDP growth will probably be close to 0 over the next few years. So I think it's a very interesting market, and we're happy to have about 16% of the international portfolio in Japan now.
Okay, I've got another one from, and Greg, I'm going to give this to you. There's another one from chat. It says, is it too late in the current climate to invest in the hot tech, Zoom and siblings, or biotech? I know I'm way too biased to answer that question fairly. So you, my friend.
Yeah, that's a good question. Is it too late? It may not be too late. It depends on your risk preference. I mean, we manage the growth portfolio. We like the cautious growth, where companies are have high free cash flow yields, and if things go wrong, there's still some value there. Whereas Zoom, it's a very exciting company. We found as users of Zoom that no one comes close to the competitor. We had other calls on Skype, on Microsoft's product, and WebEx, the Cisco's product, which we're a shareholder of. They're terrible. They're just not as good, and Zoom figured it out. Now, can they make money, and enough money to justify the share price? That's the tough question. They've gone up a lot, and Jenny and I keep debating this idea of things like Zoom. Is this going away? there's some behaviors that have changed because people can't go to stores and can't go to meetings. But Zoom, are we going to go back to all face-to-face meetings? And I think Zoom's still going to have a big place in people's lives, and as long as the technology stays ahead, they could continue to do quite well. But I'm not sure if the share prices may be too high. And then on biotech, the same thing. There's some really interesting biotech companies, and Moderna seems to have the potential to bring a vaccine to market. But then the question is, how much money are they going to make on due to the virus, and then is it sustainable? Will they continue to make that over several years, or are they back into the once the people are vaccinated and the virus goes away, does it all their earnings go away and goes back to a lower value company? It's tough to say. Our preference is to avoid the early stages of growth and high valuations, just wait for companies to mature. But that's the chicken way of doing it.
Yeah, I think if we want to pick on Zoom, just because it's kind of an interesting way to look at these kind of stocks, Zoom's up 270% this year. It trades at $250 a share, and they're expected to earn 17 cents per share. So that doesn't justify the share price. Obviously, those earnings are growing, but let's say they earn $10 a share, right? It's still a really expensive stock, and I think it's going to take a long, long time for them to earn $10 a share. So I think this is where you kind of could use the late 90s as a I don't know, tool or something to look and say, how should I play this? Because you did miss, like you definitely did miss. We all did. It moved too fast. It was 3 days kind of and off to the races. But there might be another opportunity, and I don't know if that opportunity comes with a couple of earnings where this calms down, life gets normal, Zoom's earnings start to, I don't know, become more realistic or more predictable or whatever it is. It might be trading at $100 in a year from now, and then you could invest in it. So you might be too late for this moment in time, but I suspect that you're not too late for the history of how well and how long this company is going to sustain for. They clearly have a better mousetrap, but I think today is not the day. Okay, John, we've got time for just maybe one or two more. Anyone else have any?
Just one question on the impact over the long term of, the large budget deficit and the Fed balance sheet increase. How worrying is that?
What I worry about on that, and I think we should both take this one, but what I worry about on that is that what it ultimately does is suppress growth for the future. And that if the ability for the economy and the market to grow in the future is suppressed because we have this just huge burden and we're paying tons of interest payments on it, and some huge degree of those interest payments are leaving the US, right? Some are staying in the US because there's US investors, but some are leaving the US. That could suppress US growth. If that's the case, those of you on this call are going to be fine. You have your own individual portfolio. If it grows at 5% or 8% or 10%, you're going to be okay. I think where the real problem could come in are for the large state public employee retirement systems, where they have to achieve a hurdle of 8% plus to pay off the future beneficiaries. And if they don't achieve that, they're not going to be able to make good on the payment. So to me, the suppression of future growth because of this large debt burden punishes Main Street. It punishes them. I don't know when. I don't know if it's 12 years or 15 years or 18 years. But once that punishment starts to happen, it has a really negative impact on the economy. So that to me is my very big picture, hard to get my arms around concern over the debt burden. Greg, what do you think on that one?
I'm afraid to make the predictions like this, but in theory, high deficits, and we have a $3 trillion budget deficit and the Fed balance sheet expanded by $3 trillion, that should lead to a weaker dollar. It hasn't, and any predictions of the dollar's demise have been wrong for the last 10 years. So I'm reluctant to add to those predictions, but it does seem like that the fundamentals for the dollar are deteriorating a little bit, which would have some impact. That it would make inflation be a little bit higher, possibly lead to ultimately to higher interest rates in the U.S. It could be more profitable for companies that have operations overseas, but that should be the biggest shift is a change in the value of the dollar. But eventually, you can't run a $3 trillion budget deficit forever. So either the economy recovers and tax revenues recover, or potentially a new administration is going to have to raise taxes, which is going to slow growth, where U.S. growth has looked pretty good relative to the world because they were cutting taxes in the last 3 years.
Right. Okay, so we're at 2:57, so I think we need to wrap it up and probably do not have time for one more. I would like to thank you all so much for joining us. It's been a really cool experience for us. We'll definitely do this again next quarter. I'd be grateful for feedback if you think that we should spend more time on stocks next time, less time on the macro, more time on this, more time on that. All your feedback is incredibly welcome. Thank you for sticking with us. Thank you for getting through this with us. We will continue to communicate as much as we need to help you get through this. And that's it for now. So have a great afternoon. Thanks. We'll see you next quarter, if hopefully not before. Can't wait to see you all in person again. Hopefully over sushi and ice cream and all that good stuff. All right. Thanks, everybody. Bye-bye.
Thank you. Bye.